Welcome to PIMCO Pod. In this episode, we discuss how higher earnings forecasts across corporate credit have raised the bar for second quarter reporting, while AI hyperscaler capital spending is poised to continue to drive the narrative. Stay tuned after the conclusion of the podcast for additional important information. The Credit Market Lens, a higher bar for earnings season by Lotfi Karui. Since the start of the year, the market has become more optimistic on the earnings outlook for US dollar, USD investment grade, IG corporate issuers, shrugging off the Iran conflict and consistently revising earnings forecasts higher. The first wave of upgrades came after the AI hyperscalers reported, by and large, strong earnings, but most of the improvement has stemmed from the rest of the non-financials index, with analysts quadrupling their one-year aggregate EBITDA, earnings before interest, taxes, depreciation, and amortization. Growth expectations from 5% at the end of January to more than 20% as of June 30th. And despite modest fears of an inflationary shock that would eat away at margins, the market has so far believed these fears to be unwarranted. Aggregate margin expectations for USDIG corporates have improved from 20% to 24% since the start of year, above the 2015 to 2025 median of 21%. Aside from earnings, company forward guidance vis-a-vis capital expenditure plans will remain a key focus, particularly for the hyperscalers. As of 2025, these five firms accounted for around one-third of aggregate USDIG corporate capex. Although current year capital plans are already largely set, the focus will be on additional insight into 2027 and beyond, with current forecasts for hyperscalers to account for 54% of total capex by 2027, or $915 billion. In fact, relative to 2025 levels, the entirety of the expected expansion in USDIG corporate capex has been driven solely by the five hyperscalers. AI hyperscalers include Alphabet, GOOGL, Amazon, AMZN, Meta Platforms, META, Microsoft, MSFT, and Oracle, ORCL. A second-order effect related to capex is that it directly feeds into future earnings expectations. The underlying revenues are recognized as they arise by the pick-and-shovel parts of the AI ecosystem, while the expenses are capitalized for the hyperscalers, thus won't ultimately be included in EBITDA figures. The same earnings optimism can be seen across USD high-yield HY issuers as well. Since the end of January, analyst expectations for aggregate EBITDA growth have climbed from just under 4% to more than 14% as of the end of June, with expected EBITDA margins relatively stable. To be clear, this universe of index firms is held constant as of December 2025, and thus isn't driven by any compositional effects year to date, such as fallen angels, IG issuers downgraded to HY, which would typically have higher EBITDA than the average HY firm given their size. Thus, it is more of a reminder of the resiliency of the U.S. economy so far, despite signs of a deeper K-shaped economic divide. For more, see the 13th April. The Credit Market Lens, oil supply shocks don't age well. Of course, as we enter earnings season in earnest over the coming weeks, the proof will be in the pudding for these USD, IG, and HY issuers, and we'll see if the optimism in analyst expectations proves to be warranted. Thank you for listening. That was The Credit Market Lens, a higher bar for earnings season. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.